Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Let's talk about one of the most famous investors in India, Mr. Vijay Kedia. He has built his reputation by finding small, unknown companies early, the ones that go on to multiply investors' money many times over. These are what we call multibagger stocks. But recently, Mr. Kedia has been issuing a warning, and it's a big one. He is saying the very game that made him famous, hunting for those explosive multibaggers in small and mid caps, has become extremely dangerous for the average investor right now. Step back, stop the chase. Instead, he suggests a shift in strategy, and he puts it in a brilliant, simple way. He says we need to move out of cheetah stocks and move into tortoise stocks. Think about it. A cheetah is the fastest land animal, breathtaking speed, but it can only run that fast for a very short burst. It's built for the sprint, not the marathon. It has no shell, no real protection. The tortoise, slow, steady, seems to barely move, but it's built for the long haul. It has a strong shell that protects it from the elements. It just keeps going. Mr. Kedia believes that in today's market climate, being the tortoise isn't just safe, it's actually the smarter way to build wealth. Let's break down why. You see, the math behind a multi-bagger is simple. You need two things. First, a company that's starting at an attractive low price, and second, that company needs to grow its profits strongly for many years. Now, here's the problem. Over the last few years, we've seen an incredible rally in small and mid cap stocks. Countless companies have already run up 3, 5, or 10 times in value. That means the first condition, the attractive starting price, is mostly gone. The future growth for many of these companies is already priced in. Valuations are stretched. There's very little margin of safety. This creates a dangerous situation. If there's any bad news or just a general market dip, these high flying stocks can fall very hard, very fast. So, if you're chasing multi-baggers today, you're not just looking at smaller potential gains, you're actively risking what are known as reverse multi-baggers, stocks that could lose 50%, 70%, or more of their value. The reward is small, the risk is huge. This is where Mr. Kedia's pivot makes so much sense. Tortoise stocks are not necessarily boring or no growth companies. They are established, resilient businesses with strong fundamentals trading at reasonable, not crazy prices. Their superpower is defensive strength. They have a shell. When market storms hit, they might get knocked around a bit, but they are far less likely to be crushed. They survive and keep moving forward. Mr. Kedia gives a great example, PSU banks. For a decade, these banks were cleaning up their balance sheets. Nobody wanted to touch them. Now many are in much stronger shape. The valuations are still reasonable and the business is simple. If India's economy grows, banks will lend more money. As lending grows, their profits grow. It's not a get rich quick story, it's a slow and steady wins the race story. Safety plus value plus a clear growth path. That's the tortoise profile. Now, how to build your tortoise portfolio? Well, this is not about getting a hot stock tip. It's about building a portfolio based on simple, timeless principles. The goal is to collect a group of companies that together grow your wealth steadily while protecting your capital. You can find these companies by using simple filters. Filter number 1, reasonable valuation. Do not overpay. A simple price to earnings ratio check can help. Maybe avoid companies trading at say over 30 or 35 times their earnings. The idea is to buy something worth 100 rupees for 80 rupees, not for 200. Financial resilience. This is the tortoise's shell. Look for a strong balance sheet, low debt, good consistent cash flow. Now, this strength lets a company survive tough times and even gain ground when weaker competitors struggle. Shareholder discipline. Look for a history of paying dividends. It does not have to be a huge payout, but a consistent dividend often means the management is disciplined and cares about sharing profits with owners. If you are considering a similar move, here's a watch list of 20 stocks that might fit the bill. By selecting from the top 250 companies in India and applying basic screens for reasonable PE, consistent dividends, and balance sheet strength, one can build a basket of 20 such tortoise stocks. Now, if you had done this 10 years ago in December 2014 and just held and rebalanced that portfolio once a year, what would have happened? By December 2024, that tortoise portfolio would have multiplied your money nearly 6 times. Compare that to the broader BSE 200 index, which multiplied money about 3.2 times over the same period. That's the power here. This isn't just about hiding under a shell and not losing money. It's about a method that, by focusing on quality and value, can actually outperform the market significantly over the long run. The simplicity beats the complex, high risk betting. To make this work, you need patience and discipline. Now, not every tortoise stock will shoot up every year. Some will just sit there. Some will even go down. You have to trust the portfolio as a whole. Rebalancing once a year is key. It forces you to do something psychologically hard, sell a bit of what's done really well and maybe become overpriced, and buy more of what's lagging and might now be a better value. Remember, the filters are just a framework. The core idea is universal. Invest in proven businesses with a strong track record and never overpay for them. Now, here's the elegant part of this strategy. You're not giving up on growth forever. The market moves in cycles. Greed is followed by fear. High prices are followed by corrections. By parking your money in tortoise stocks now, you do two crucial things. You protect your capital from a potential crash in the overpriced parts of the market. You build a stable, liquid pool of capital. Then, when the inevitable correction happens, when those once hot small cap stocks are lying in the dust, cheap and hated, that's your moment. You can calmly move a portion of your capital from your sturdy tortoises back into now undervalued cheetahs. You go hunting for the next multibaggers from a position of strength and safety, not from fear and greed. Mr. Vijay Kedia's warning is a vital lesson. Successful investing isn't about sticking to one strategy no matter what. It's about reading the market environment and adapting. Right now, the easy money in small caps has likely been made. The risks are high. In this environment, the slow, disciplined, conservative path of the tortoise isn't just wise, it's a powerful strategy for long-term wealth creation. It focuses on preserving what you have, compounding it steadily, and giving you the patience and financial strength to seize the next big opportunity when it arrives. In the long race to build wealth, sometimes the slow and steady path isn't just the safest way to go. It turns out to be the fastest. Well, that's all from me today. Thank you so much for watching. Until next time, happy investing.